Before we get into the whole FMCG sector, I mean, I'd love to start talking about your thoughts on the market's performance so far this week compared to how it performed last week. We started the week off well last week, and then, you know, we sort of saw the markets slow down during the course of the week. What's your take on what we're going to see this week?
Yeah. Well, I think it's likely we see, sustained, gains in the market, obviously at a moderate pace than we've seen over the last month or so. And the reason for that is, I think gains so far will be driven mainly by momentum. Some investors, particularly foreign investment flows, basically, playing to the current momentum. And as long as you continue to see that strong, inflow of foreign portfolio investment, I think that there is obviously reason for the market to continue to rally. There is obviously value, particularly in some of the banks, with tier 2 banks. I think that from a growth perspective, tier 1 banks also make some sense. And even in the consumer space, if you're looking at names like UACN, we've seen demand for, much smaller tier 2, consumer players like 7-Up or GSK. So I think you continue to see money flowing into those names, and I think that will provide strong support. But looking at the value traded, liquidity starting to wane. We did roughly about $9 million yesterday, and this is coming from an average of close to $15 to $20 million daily. So I think that is really what we'll expect in this week. Bear in mind that eyes will obviously be on the U.S. election today, because that has significant implications for foreign investment flow. It will give investors a decision to decide if Nigeria or Africa is a place to continue sending money. Obviously, from a foreign portfolio managing perspective, it will obviously set the tone as to whether the loose, fiscal monetary policies that we've seen, with some of the developed market economies will continue or not.
Right. Well, I mean, looking back at Nigeria's market, focusing on the consumer goods sector, I mean, let's start with one of the big players, Esili, Nestle. I mean, looking at its performance, double-digit year-on-year growth, both in turnover and profits. Do you think that company is on track to meet its targets for 2012, of course, as we round the fourth quarter of the year?
Well, answer your question directly, if you look at the guidance management has put out so far, I think that they're more likely to exceed that guidance. I mean, the gap between what they issued and where they are currently is roughly about 1.7. I mean, just doing a quick mathematics, Nestle's, Q4 is traditionally the strongest quarter, so there's no reason why that company can print anywhere close to about 5 billion in that quarter. So if you extrapolate that number, you're looking at a PAT much closer to about 20 billion naira. So we're looking at very strong performance. Nestle still remains, I think, one of the most effectively run company in our opinion, and I think that that's what's basically feeding through the bottom line. Bear in mind that it's got a much bigger distribution footprint, efficient distribution footprint relative to most of its peers, and that's also what's feeding through. There's also been currency gains, lower than anticipated interest costs have also played positively for Nestle's numbers.
And talking about one of its peers, Cadbury, I mean, performance also strong. However, some concern over weakness in its operating performance. I mean, what's your take on the performance of this stock?
I mean, the key highlight there for Cadbury is that the performance at the bottom line has been mainly driven by investment income. I mean, for a manufacturing company, that's clearly quite odd, where investment income contributes close to about 40% of your PBT. So that really is a concern for us, and we're basically seeing a much weaker performance relative to its consumers. Yes, we have seen a slowdown in consumer spending generally that's affected the whole consumer universe, but Cadbury's numbers are showing much weaker growth. So we're basically watching performance there. It's likely that its Q4 performance will be weaker than what we've seen the previous year, or lower than the previous year, the same quarter previous year. But I think that with respect to growing its sustainably growing its performance over the medium term, the numbers we've seen so far this year, I think, obviously raise some concerns.
Well, let's see, what's your take on, of course, the short and medium-term performance of other stocks like Dangote Sugar? I mean, looking at its Q3 results, revenues up just 2%, PBT up 85%, however.
Yeah, the issue with Dangote at the moment is that you're seeing, a sharp decline in input costs lending, to EPS growth, and that's why you're seeing levels of about, 85% year-on-year growth. It's likely you see that sustain into the fourth quarter. But I think what we're basically worried about at the moment is the top line where we're seeing some weakness, So a number of things come into play. One is, the softness in consumer spending. Secondly is competition. And to highlight again, they had an incident quite recently with their facility where, the bigger plant was gutted down by fire, and that has obviously constrained their capacity. So I think that's a big risk for volumes in the fourth quarter, especially now that they're starting to run out of inventory. So we're basically looking at that, but I think there's a great chance that numbers still appear much stronger in the fourth quarter than they were the previous quarter, the previous year.
Right.
So I think investors are more likely to respond to that, and the stock itself has rallied quite strongly year to date on the back of a deal recently by Tiger Brands and Dangote Flour, because investors are betting that you're likely to see a similar deal with Dangote Sugar.